Good day, and welcome to the Casual Corner with Makai and myself. And today we are going to be talking or answering your frequently asked questions when it comes to life insurance. How are you, Makai?
I'm great. How are you,
I'm
Keisha?
good. I cannot complain. So let's get right into this. We have a list of frequently asked questions that we got from the public. And the first one on the list is, what are the different types of life insurance?
So the different types of life insurance that we offer here at Friesenbrook are term and whole life policies. The difference between the two is quite simple. I like to say T for temporary, P for permanent, participating, as we like to say.
So when you say participating, what does that actually mean in the scheme of a life insurance policy?
So participating to us is a whole life policy. It's a policy that lasts until your last breath. With us at Friesenbrook, we offer policies that you can pay into for 10, 20, or until you turn 100. The benefit of these policies is that they grow in cash value. Cash value that you can learn from in the future, cash value that you can possibly withdraw from. But the best part about these life insurance policies is that it has an increase in death benefit.
Okay, that makes sense. So I guess that's the participating aspect is the fact that the policy itself is appreciating in value. It's gaining interest essentially yearly. So in growing and becoming better, the longer you keep it in place, that's actually pretty good.
Yeah.
What would you say, in your words, is the difference between term and whole of life outside of the T for temporary and P for permanent?
So when we tap into a term policy, the clients that may grab a term policy are clients that may have mortgages, that have existing debt, that may have kids, starting a family. You want to grab these policies because they are most reasonable in cost. The longevity of these policies do last until you are age 85. However, the coverage that you get is immaculate to the price that you pay.
Okay.
Whole life, P for permanent, participating, that's more of a policy that you would use as a safety net. So a policy that grows in cash value, can last for the rest of your life as long as your premiums are paid up. And it's kind of just has much more benefit to your financial future, let's say estate planning and protection.
Okay. Well, yes, providing the premiums are paid up. You can't forget that part.
Yes.
So that makes a lot of sense. I would say, so am I right in thinking, okay, if I have a goal to, one, purchase a home, put my kids through school, everything that I need to do while I'm alive, essentially, that's going to cost me my hard work and money. Mm-hmm. If I'm no longer here, a term insurance policy is going to solve that temporary need immediately. So when it comes to the cash values or the participating aspect of the whole of life, is the cash values considered, let's say, profitable to myself? Like, is it, let's say I wake up and I'm like, hey, look, I've got this much in my cash value. Should I be accessing that just freely or how?
Honestly, I would say utilize your policy as a safety net. So it's literally something that's there in a case of need. I wouldn't say, one day I might need some money, so I'm going to grab into my life insurance policy. I would use it as a last resort. Don't go first to your life insurance policy because you're going to take away from the death benefit. Okay. So I would recommend to use it as a, hey, I may have to go away for medical reasons, I might need to take away from my policy. I would definitely say utilize it for that because there's reasons that, just come on.
You don't have much
You
choice.
You don't have much choice.
Yeah. Okay, so that is very, very interesting. Thank you for that insight into that. So would you say, now I know we've talked about whole of life as a last expense resort. Now, I'm pretty sure there's other use cases that could be valuable, not for the older generation or for people thinking about death at this point in time. Are there other ways that we could use the whole of life product and a participating aspect and use that time, that window to build more value for individuals?
Yes, I'm glad that you asked about that, Keishan. The best policies that are sold today are child life plans. Child life plans are really good for thinking about education, thinking about the child's financial future, dreams that the child might have. One day your child might want to buy a home. This policy can actually help towards the down payment of, the mortgage of a home. or this policy can help towards the child's educational future and whatever dreams the child may have. What I would recommend is to leave the policy and allow for the child to withdraw from the policy if they need to once they get of age, for the reasons of possibly looking to buy a home or to go to school or to even start a business.
Okay. So you're telling me that a child from birth can have a whole of life insurance plan that increases in value the longer they live from the age of a newborn.
Yes.
So by the time they are at retirement, we're talking 65 years because they got it at birth. 65 years of interest compounded in a life insurance product that they have access to at retirement that you did for their parents while they was a kid. That's amazing. I mean, I know we touch on this generational wealth topic a lot. And it sounds like that seems like a product that really ticks that box.
Yeah, for sure. And to take it away from more so withdrawing or learning from the policy, if you open up the policy for your child at maybe 10 days old, and you left the policy, you didn't withdraw from it, and once you gave them the keys, once they became adult age, and they didn't withdraw from it, let's say they passed at retirement age, that policy has grown significantly because you only opened up maybe, let's say, $100,000. You probably paid, let's say, $140 per month for 20 years. You stop paying after 20 years. Once that child becomes 65, they pass on, it's a significant amount of coverage that will be paid out to that child's beneficiary.
That's amazing. So you're basically essentially taking far less money to create a legacy for somebody that's going to be worth far more money than the investment itself.
Yeah, for
So
sure.
it's a very smart thing to do.
And if you think about it, you opening up that policy for that child, they may not need to open up another policy as they got older. They would more than likely open up a term for themselves because they would want to transfer the generational wealth. So they open up a term for themselves. It might be for less, maybe just for a mortgage, maybe just for debt that they may have, just to cover so that their children don't have to take on that debt. However, talking about leaving money to their children, they won't have to because that policy would have a significant amount grown if they do not touch
That's amazing.
the value of the policy.
That's amazing. So looking at the differences between the two policies, it sounds like the term insurance product is more of a immediate protection need. It sounds like the whole of life product is more of a creation tool where you can use to create value for far less money than the cost. And it also sounds like they might work pretty good together.
Yeah.
To have a goal that you'd like to create, to build and meet your legacy goals. But if the worst were to happen, you need that thing in place to still meet your goals.
That's correct.
In the worst case scenario. So, that's some good information, Makai.
Thank you, Kishan.
So that wraps up today's episode with Makai and myself about your frequently asked questions surrounding life insurance. And we hope to see you again for the next episode.